It's time to check your money with Mike Jennings. Mike Jennings is a wealth advisor with Brackens Financial Solutions Network, LLC, and the registered representative of LPL Financial, member SIPC. Mike, June is here, my brother. It is here.
June is here. June is here. I don't know what's been going on with the weather, but
It don't feel like June.
if I look at the calendar, technically it is June.
It
But
is June. Or
August.
I should say, not that it doesn't feel like June. May gave us a lot to be desired. Let's say it that way.
Let's say it that way and
We're
leave it
glad
at
to see it go. June is also birthday
it.
month as well, so we'll get into that a little bit.
All
But
right, all right.
yeah, birthday month coming up. This is birthday month. Yeah, 10 days, my brother. 10 days.
There we go. Oh, so you're not. I'm only a month behind you.
A
Well,
month behind me, and
maybe
many.
some years,
Yeah, I
couple
was
of
gonna say,
years.
and many decades. Four score and 7 years ago. At least three score. Anyway, so what's going on, Mike?
What is going on? God, we have been coming on here every week and giving everyone the rundown on what's been going on, and sometimes it feels like we're repeating ourselves, but that's just the nature of finance. History repeats itself, or at very least, it rhymes. So, we have to keep coming on here and making sure people understand things that are going on. And one of the things I felt was very relevant, something that we've touched on in the past before in other episodes here and there. But that is credit. Recently, if you looked at some of the headlines coming out, for example, millions of Americans are facing large credit drops from the student loans being in default, and the whole initiative behind that, and people, the government looking for their get their money back. Medical debt still an issue for many credit users. And more Americans are falling behind on a newer concept with credit, which are buy now, pay later loans.
Oh,
So there's a lot of things going on that is affecting people's credit. But what I found in some of my conversations just in the last couple of weeks with some prospects is that people really don't understand credit, like what it is and how it works. And that is not a fault to them because it is a very complex thing. So I figured I'd come on here and just give people a rundown of some different areas around credit and see where we can go with that. Is that good?
that sounds good to me.
All right, all right. So let's get into it. First of all, credit. We all know we have an idea of what credit is, right? You are acquiring something of value and then paying it over time. It's a system of debt, right? So with credit, you have revolving credit. So these are things like your credit cards, personal lines of credit, home equity lines of credit, HELOCs. You also have installment credit, which are things like your auto loans, student loans that we just mentioned, mortgages, and the buy now, pay later sort of thing. So that you Afterpay, Affirm, Klarna, things like that.
Klarna, what else? Whatever they, yeah.
Exactly. The
Very familiar with all of those. Thank
the
you.
the shopping cart gotchas right there. It's like
Oh
the
my God. Eat four payments of $50. Sign me
oh,
up.
you remember layaway? Whatever.
Yeah, I remember layaway. And a lot of stores stopped doing that, right?
Right. Now it's not layaway. It's here you can have it, but you lay some money down too in a couple of
Well,
weeks.
I'll give you one more thing, right? Even my bank is doing that. So
Really?
I bought something and then they said, hey, if you want that money back, we'll break it up for you, my brother. So, and I don't know what the incentive was for the bank to do that, but yeah, even the bank is doing that.
Listen, they're gonna get you. They're gonna package it up real nice. However they frame it, they're gonna get you, right? So again, we have revolving, installment, and open credit. So these are things like utility bills. I know people are like utility bills. How's that credit, right? Listen, it's something that is a financial responsibility. And I can assure you, if you don't pay your utility bills, it'll show up on that credit report.
Hmm.
And charge cards, things like that. So that's open credit, right? So how do these things affect your credit overall, your credit history, I should say, right? Um, Payment history. That is the largest, actually, the largest contributing factor to your credit score. the amount of debt that you owe, and typically the utilization as well. I know we all heard of the 30%, 30% rule of thumb, right? So if you have $1,000 in credit, make sure that you're only carrying 30% or under, on the next revolving
And that's for
cycle, right?
everything, right?
Yeah,
For everything,
across everything. So you take
right?
the total amount that you owe on all of your credit cards, all of your lines of credit, and then that's your credit utilization. So it's a total aspect as
So,
well.
so like you said, if you have $1,000 in credit
Hmm.
available to you on one of your credit revolving credit, let's say a MasterCard or whatever,
Hmm.
basically $300 is all you should have on that. Now, that's on average, right? Because if you go on a
Hmm.
trip or if you put your tickets on a credit card, then it may go up a little bit, but there's
Hmm.
ways to deal with that. But go ahead.
That's right. That's right. You got it. So the total amount owed, length of credit, also a big one. Because that shows how long that you've been able to manage debt. Now, if I look on my credit report, one of the biggest things against me is there's like, yeah, your credit accounts, your oldest credit account is too short. And I'm like, my oldest credit account is my student loans. I've had that for, at least 15 years. So something like that. So,
Right, right.
it's very, they're looking a long frame of time as well. Another thing people underestimate is also credit mix. Not the biggest factor, but it's also something as well. The lenders, they want to see that you can handle things like an auto loan, but also at the same time handle things like credit cards, handle a mortgage, handle student loan, any personal line of credit, anything like that. They want to see a good mix of credit as well. So it's not just like one thing
And to
uh,
your and
over
to your
time.
point, some things are more important than others.
Oh
So
yeah,
your mortgage and your car note versus, a department store credit card. Not saying that you shouldn't be on all
exactly.
of that, but they're not weighed in the same.
Exactly. Because like a credit card, okay, you're paying it off every month and that's what, but a mortgage, that's a 15 to 30-year commitment right there.
Right.
And then also new accounts. This is something people fall into a lot. I know we just passed Memorial Day weekend. I know a lot of us were at the mall. We get up to that counter and they're like, listen, you wanna save another 30%? Open up a
Yeah.
store card. Listen, you do that too many times, it'll definitely have
Maybe
a
look,
negative impact on your
listen, Mike, it's
credit.
enticing, right? And then you say, okay, I'm only gonna do a little bit on that. And then
Right.
the next thing you know, and then they love you so much, Mike, they will also increase your line.
Hmm. Hmm.
So,
Hmm.
and then all
Yep.
of a sudden you're like, oh, okay.
So those are the factors that go into your credit score. Now, I keep talking about credit score, right? Credit score, and everybody knows like you have credit, you have a credit report, and you have a credit score, which is pretty much just a general idea of how good you are at maintaining debt. But when it comes to that, a lot of people really don't understand that there are not only different platforms of credit score, but also within those platforms, there's different models as well.
Right.
I know a lot of people know of FICO, the
FICO
FICO
score.
score.
Yeah.
FICO score that's been around since I believe the 80s. It's the oldest scoring model that's very widely used at over 90% of lenders in
Yep.
every industry use FICO score. Now, which score that they use is a little bit different here because um, some of the older models, so like some of them are like numbers. They're almost like sequels and stuff. So you got the FICO 2, you got the FICO 8, 9, 10, all the way up to the 10T, which I think is the most recent one, right? They all treat credit and your credit history and your credit behaviors differently. And they keep coming out with these new models that kind of keep up with the evolving landscape of the economy and finance and how we use credit. So things like buy now, pay later, right? When those first started coming out, people really didn't have an idea of how that would, contribute to your credit. But now that it's been a little bit of time, the credit bureaus and the credit modeling systems, they're kind of weaving their way into contributing those into your credit score. Um, Not only just that, but there's also industry specific credit scores. So you have the FICO score for FICO Auto. That's just specifically for auto lending. So if you go to a car dealer, try to get a car, more than likely they're going to use the FICO auto score. Then there's the FICO bank card, which is for credit cards, store cards, things like that.
Hmm.
And then FICO 2, 4, and 5 for mortgage lending, depending on which lender you go to.
Yeah,
Uh,
and we should also say, Mike, that and depending upon, like you said, depending on what you're applying for, let's say you look up your score, your score, right?
yep.
Different lending institutions are using different measurements, just what you
Yeah.
just said, right?
And
So you look at one and says, oh, I'm 700 this, but then over here you could be 697, and over here you could be 678, right?
yep. And it's funny you say that. I just saw an email from was it Capital One, I think, and they're like, yeah, we're gonna stop using Vantage 3 3.0. We're gonna use FICO 8, which is
Mm.
a newer model. But it's like, well, at the same time, why were you using this old score? So these lenders, they're also there's some runtime, there's some lag time there between
Mhm.
them adopting these newer scores, which
Right.
could technically be better for you. But that's just how the industry works. It's late in adopting things like that. And also with the FICO score, each bureau, so TransUnion, Equifax, Experian, you have a different FICO score for each one.
Each one.
They have their own algorithms, right? So that's FICO, and now you just heard me mention Vantage score. So that's the newer model, or newer sort of modeling system. This one was actually created by the three bureaus. It was a joint venture between them, and the idea was it so that you didn't have three different scores. You had a sort of
A
a joint score,
combined.
a combined score
and
for
and
all of it,
and,
right?
and I wanted to point out, like, recently, not long ago, we were shopping for a new vehicle, had totaled the car, had to
Mhm.
find a new vehicle.
Yep.
And one of the things that we learned is that, again, that car dealer used this particular service, which yielded this particular score, which could be different than the one down the street,
Run right down the street.
right? So you have that to factor in as well.
It's tricky, it's muddy, and people have no idea how to. So let me finish up with Vantage, right? So it's a joint score for all three. It has different algorithms and weighting. They weight different items differently. And also the Vantage score, especially the newer one, I think the 3.0 or the 4.0, it uses trended data, so
Mm-hmm.
that credit usage and the behavior, it looks at a average, a period of time instead of just the last billing cycle, which a lot of the FICO scores, it does that. You miss a payment one month, you'll be a big hit on your next billing cycle when it comes to your credit score, versus when you have trended data, it's like, okay, the last 23 months you were okay, so we're not really gonna hit you with the hammer on the last month
Mm-hmm.
that you
Mm-hmm.
missed the payment, right? So that's also an advantage there. But like I said, FICO, it's almost a monopoly on the lenders that used FICO score. That's is down and out the most widely used model system. Now again, which model that they use is based on the industry and also based on other things, and they are a little bit slow on catching up. So, like you said, it all depends on where you go and what they use. So how does all of this sort of come together, and what other things should we be looking out for, right? So,
Mm-hmm.
again, just to reiterate, you don't have a single credit score. You have many that are used by different lenders. The FICO score is the oldest modeling system, and the models that are considered outdated for the current landscape of credit use, and that can work against you, right? If FICO 10 being the latest one, if one of your if your bank or your credit card lender is using an older model, some of those factors, some of those behaviors might work against you more than it would on a newer model. Um, like I mentioned before, the recent targeting of student loan debt holders will have major impact. Some people are already seeing that, right? And that's going to affect millions of people. I just saw an article earlier where someone in one day lost between 100 150 points on their credit score, and that's
Because of the
just
student
from
loan.
because the student loans they were originally in deferment, then it became in default, and now that the government said, yeah, we want our stuff back, it's affecting them. So that's a big one right there. And many Americans have student loans and will continue to get student loans because that's pretty much the only way you can get into college these days.
Right.
Another major point is that I mentioned quickly was the medical debt, which has been sort of a point of contention because medical debt is I was going to say a killer, but I didn't want to a little too on the nose there.
Right.
It's often very high and it's unmanageable for most Americans. The newer models of FICO and VantageScore they sort of had their own initiative of excluding medical debt. But again, the newer models are used less by lenders. And the Consumer Financial Bureau or Protection Bureau, they actually came out with a rule at the end of last year, but actually I think January of this year, where they were seeking to ban medical debt from showing up on your credit report and having it factor into it. Of course, with the new administration, with the CFPB pretty much being out the door, they also reversed that and actually joined the people that
That's
did
the
a lawsuit
Consumer
against
Protections Financial Bureau.
Consumer Financial Protection Bureau.
Protections Bureau, yeah.
Which is pretty much what it sounds like. It's trying to protect people from all sorts of financial mishaps and things like that. Like I said, the administration is doing away with that, and they're reversing that rule that they just tried to place on banning medical debt. So that was a lot. I know that was a lot. And there's so much more I can get into, but we only got so much time, and so many people to help. So if you want to learn more about credit, please, and let me throw in this too. Anybody that is advertising themselves as a credit repair shop or people, things like that, listen, take that with a grain of salt. The number one, the biggest thing that is going to help your credit is doing better in the future. It takes time. You just have to let some of these things fall off. I know some people tell you, oh, I can write a letter to this person, that person, get this thing taken off, get that thing. Listen, just try to do better and keep doing better. That is what's going to fix your credit score, right? If you want to learn more, give me your friendly neighborhood advisor a call at 315-748-5540 or send me a quick note at michael.jennings@brackensfsn.com.
All right, Mike Jennings is a wealth advisor and financial planning associate at Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial member SIPC. He is your friendly neighborhood advisor.